Welcome to GRE. I'm your host, Keith Weinhold. There's so much to pack into one show today. Inflation at its highest rate in over 40 years. The Fed raising interest rates the most in 28 years. Rents are going up fast. Then GRE's COO, Aundrea Newbern, and I on our favorite real estate investor resources today on Get Rich Education. GRE listeners can't stop talking about their service from Ridge Lending Group and MLS 42056. They've provided our tribe with more loans than anyone. They're truly a top lender for beginners and veterans. It's where I go to get my own loans for single-family rental property up to fourplexes. So start your pre-qualification and you can chat with President Chaley Ridge personally. They'll even deliver your custom plan for growing your real estate portfolio. Start at ridgelendinggroup.com. You know, a lot of investors choose either cash flow or home price appreciation, but one real estate market could provide both: Jacksonville, Florida. They've got 27% lower home prices and higher rents than the national median. Their market has appreciated 34% more than other comparable cash flow markets over the last 30 years. Get positive cash flow today and above average appreciation for tomorrow. They often have available inventory in Jacksonville, if you can believe that. Start at cashflowandgrowth.com.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE, from Auckland, New Zealand to Oakland, California, and across 188 nations worldwide. This is Get Rich Education. I'm your host, Keith Weinhold. Before I discuss real estate, what's happening with inflation and interest rates is so exceptional that I want to cover this first. When the latest inflation reading came in at 8.6%, it dashed hopes that inflation has peaked. We don't have any evidence that it's peaked. And as I like to say, that 8.6%, that's just the level that the government is willing to admit to. It's really higher, and it was a third month in a row that it has exceeded 8%. Treasury Secretary Janet Grandma Yellen has already warned of what she calls unacceptable levels of inflation after downplaying it before that. And yeah, Yellen looks like my late Grandma Weinhold. Yeah, they look a lot alike. One difference, though, is that Grandma was not wrong about inflation. Another difference between my grandmother and Yellen is that Janet Yellen never gave me Star Wars action figures on Christmas like my grandma did. Well, for a lot of people, especially, say, in the lower middle class, it's become a scary world with devastating $5 to $6 a gallon gas, soaring food prices, spiking rents, which I'll get to shortly. The medical system is still a mess, and wages are up perhaps only 3, 4, 5%. So their quality of life is really suffering now. Libertarians point out that fiat inflation, that it is theft of one's private property. You earned $1, and now your prosperity has been stolen. And sneaky shrinkflation is stealing from you too. Yeah, you're not just imagining this stuff. Gatorade has trimmed its 32-ounce bottles down to 28 ounces. A small box of Kleenex has shrunk from 65 tissues down to 60. Packet sizes are shrinking faster than Lake Mead, all while producers charge the same price or more. That's what shrinkflation means. It has become an awful economic malady for consumers. So let's talk about higher interest rates, since that's the tool used to keep inflation from soaring. Now, a lot of interest rate types are based off of the federal funds rate, something you can sort of think of as a base rate. I like to look at history to see what typically happens in like scenarios. History doesn't tell you everything, but a lot of people just don't look at it at all. Now, rewinding just 3 years, this rate was hiked up to 2.5% by early 2019, and the stock market was freaking out by then. President Donald John Trump, he even demanded a rate cut. He got it, and that turned stocks around. And yes, presidents are supposed to stay independent of the Fed, but in any case, just last week, the federal funds rate was raised up to 1.75%. And the stock and crypto markets have already taken a swan dive off the high board. Everyone thinks that rates are going to be raised again as well at the next Fed meeting next month. So how do you think that equity markets are going to like that? History shows us that they do not. But see, history shows us that even when the Fed funds rate is raised to 10%, 10%, it can take years to quell inflation. Now, in inflationary times or recessionary times, it's really commodities like housing and food and energy. That's what excels. That's typically where you want to be. So you want to buy and own what people need, not what they want. These things have a finite supply, and bringing them into existence takes what's called proof of work. Are you familiar with that concept? Proof of work. It actually comes from the cryptocurrency in Bitcoin world, but that really just means that it takes real world resources to produce things, like to extract something or produce roof trusses or growing timber for lumber or mining gold, extracting oil, growing wheat. If you held any of these commodities individually, all right, what you might do is merely hedge yourself against inflation. But if you can control an entire commodity like these things by only putting 1/4 or 1/5 of your skin in the game, well, then you get to short the dollar too. Shorting, that's a term from the stock world. It just means you're betting that something's going to fall in value. You're betting that the dollar is going to fall in value in this case. A pretty sure bet. Well, now that you've borrowed, you're creating leverage and arbitrage, and you're really profiteering. You're really in the black from inflation here. Real estate is like this basket of commodities made up of lumber and copper and glass and all kinds of commodities. So if you have just $1 million in real estate debt, if you were able to get a hold of that, well, that's now being debased at a rate of 8.6%. That's great. This effect alone has increased your prosperity by $86,000 just in this past year alone. And of course, that's besides appreciation and income and tax benefits and amortization. Yeah, you've got an $86K tailwind. Now, hey, do you remember back in 2019 when I did the podcast episode called The Debt Decamillionaire? It was episode 260. You might remember that episode. That's when I touted the counterintuitive merits of taking out $10 million in real estate debt. Of course, you're going to do that with the payments outsourced to tenants. That's what makes it good debt. Now, I know that not everyone has the wherewithal to take out that much. But if you were able to implement that plan, just consider it has now created an extra $860,000 of annual wealth for you. Yes, as one of just 5 ways that you're paid. But of course, leverage probably paid you more than this inflation profiting benefit did on the long-term fixed interest rate debt. And you know, if you think all that sounds scary or unconventional, well, it's definitely unconventional. And that's because being conventional doesn't get one anywhere. So, although you might not have been able to amass that much good debt, I was ahead of the inflation, helping you get out in front of it to take advantage of it. Of course, I talked about it well before 2019 also. And no, I sure didn't know that a pandemic was coming in 2020 and was going to bring all this inflation this quickly, but that is how things worked out. Now, if you're just completely uninitiated on this, or say you're a new listener, if you originate $10 million in loans, understand something. Your net worth didn't just decrease by $10 million on the day that you got the loans. The day that you originate the loans, what happened is that you've now got $10 million in your asset column and $10 million in your debt column. Leverage amplifies the $10 million in your asset column, and then your debt column erodes through both tenant-made principal paydown and this higher inflation. And yeah, maybe I'm stretching your thinking merely by discussing 8-figure debt like this. So why is someone really compelled to be a real estate investor today? One big reason is that soaring inflation is going to be around for a while. So last Wednesday, when the Fed raised interest rates 0.75%, which was their highest daily increase since 1994, understand something. Higher interest rates decrease demand. There's another name for substantially decreased demand, and that name is a recession. I don't know if we'll get that far. Now, capitalism, that's not something that's inherently inflationary. Sure, as employers' demand for labor rises, that part's inflationary. But as businesses compete to offer goods and services at the lowest price, which is capitalism, that is deflationary. Libertarians are quick to point out that America has too much government intervention to be considered a truly capitalist economy anymore. That's a different conversation. But some have speculated that politicians are plotting another stimulus check drop on American citizens so that they can deal with inflation. I really hope they do not do that. Oh my gosh, that would be a policy blunder. That would be like shooting a man that's already dead. This absurd approach of printing up currency would be to help people deal with the consequences of printing up currency. And if you think that's preposterous, well, Quebec is actually doing this. They're issuing $500 stimulus checks to help the Canadian province's residents deal with inflation. Yeah, that's really happening. Soaring gas prices aren't just painful for summer road trippers because fuel is a critical input for so many goods and services. Higher costs are causing havoc across the economy in some places that you would expect and definitely some places where you totally wouldn't expect it. Now, aviation, that might be a place where you expect it. U.S. airfares skyrocketed 19% in April from just a month earlier. That's an increase that is almost exclusively driven by a jump in jet fuel prices. That's what United CEO Scott Kirby said. Now, you might have expected that one, but get this. In the law enforcement world, a sheriff's department in Michigan instructed its deputies to cut back on visits for non-urgent calls because it had already blasted through its fuel budget with months remaining until a new one kicks in. Yeah, inflation diminishing your law enforcement. In the emergency services world, an ambulance crew in Pittsburgh said it was limiting its service outside of 911 calls after facing a similar budget crunch. Its fuel expense for the full year is typically $50K, and it's already gotten close to that just entering June. In landscaping, lawnmowers and the weed whackers you have come over to your yard, they use gas to make your front yard the envy of the neighborhood. But after absorbing all of the cost increases that they can, some landscapers have slapped a surcharge on customers, and others are even looking into electric mowers and propane as an alternative fuel this summer. In any case, a look at history tells us that we could be in for high inflation for a full decade. So make financial decisions accordingly. We're in a different world than we were just 2 or 3 years ago. Risk assets are typically really sensitive to big moves in inflation, in interest rates. That's why major stock indices are down. And cryptocurrencies are in an all-out historic meltdown. They're more volatile than stocks, and a lot of cryptos have lost 50 to 60% plus of their value just this year. Some crypto trading platforms have halted withdrawals, freezing depositors' funds. Companies have cut jobs. Panic investors have dumped their holdings. And anymore, I think the public is finally dismissing crypto promoters' claims of, hey, I made $50K on Doodoo coin, so can you. You don't really hear that pitch anymore lately. Let's go Brandon coin. Yes, that is a real thing, just to show you the height of the absurdity. Let's go Brandon coin is now worth $0 and 0 cents. You saw in last week's newsletter, I was writing you that Let's Go Brandon coin makes Dogecoin look like some sort of respectable family heirloom. I actually still think Bitcoin could have some potential, but well then where to look? Like where out there in the investing landscape do you go for yield today? And you feel like you have to because some feel that the true rate of inflation is 15%. Well, that's how much prosperity you lose each year by storing cash. And I still do believe it is wise to hold at least 3 to 5% of your real estate portfolio's value in cash or cash equivalents, even though that small portion might be exposed to inflation. One place to look, I guess it could be oil, if you still think there's a run-up to be had there. Oil has performed well so far this year. Gold really hasn't awakened despite inflation. What you can do is follow the money. Big institutional players like American Homes for Rent, they keep plowing money into real estate, especially single family rental homes. That's historically the place to be in times of either high inflation or a recession. And although the institutional share of these institutions like American Homes for Rent, although that institutional share is increasing, still the overwhelming majority of homes are bought by individuals just like you. In the fourth quarter of 2021, institutional buyers only comprised 18% of home purchases. So as affordability clamps down most drastically on these wannabe first-time home buyers, unfortunately, a lot of these fine people, these fine families, they never make it to the closing table. Every 1% in a mortgage rate increase, that decreases a buyer's purchasing power by 12%. Mortgage interest rates are now 6% plus on owner-occupieds and about 7% on rentals. I believe that the only way that houses are going to get more affordable anytime soon is if mortgage rates come down. That's because home prices are not poised to come down anytime soon. So what do these priced out people do as rates and prices have become higher? Well, increasingly, they become your renter. Rent price growth is predicted to outpace home price growth this year. Finally, we'll see if that really happens. And although some measures are lower, Rent.com's rent report shows us an astounding 26% annual national rent increase. I'll put that resource in the show notes for you. While a lot of major markets are struggling with this streak of Fed rate hikes that could drag on and on and on, like drag on longer than the final 2 minutes of an NBA game, understand, for real estate investors, the rent just keeps flowing in. And here's what it comes down to. Picture this, like I've discussed before. First, home prices rise, and then rents follow with their rise later, lagging behind. Picture two waves. Say that these two waves are 18 months apart. The first wave is an increase in home prices, and today prices are still climbing, but the wave has likely crested. That second wave that's coming in now are these torrid rent price increases as those wannabe first-time home buyers and others get priced out. The trough between the two waves is where the cash flow is lowest on new purchases. And now the second wave, that rent increase wave, is building. That's the seafaring here in the rental housing market ocean, if you will. Hey, in the past, I've discussed where I've invested and what real estate types I like to own. Why don't we hear from GRE's own COO, Aundrea, Newbern, MBA, about how she's positioning her portfolio in this environment of normalizing prices and spiking rents. Also, she and I will discuss some of our favorite resources and websites for real estate information. That's straight ahead. I'm Keith Weinhold. You're listening to episode 402 of Get Rich Education. For accredited investors, if you've ever wanted 10 to 12% passive income returns, Wagner and Alasko and his professional partners could have the right answer for you with real estate, one of the safest assets available on the planet. On a preferred return basis, you collect your money before anyone else does. I encourage you, go ahead, learn more about their opportunities at I'mAccredited.com or text 305-684-2222 for your free investment guide. Hey, my friend Damian Lupo informed me that checkbook IRAs have been made illegal by the U.S. tax court. If you have a checkbook IRA, your holdings are now disqualified with taxes and penalties up to 50%. But don't panic, Damian and the EQRP company can fix this. Those IRAs can be converted into EQRPs retroactive to last year, getting those tax deductions and reducing your taxable income. In this way, you can invest your 401k or IRA in real estate, Bitcoin, gold, and even your own business. So whether you're a full-time investor or retired or even a dentist with dozens of employees, if you're listening, you qualify, the EQRP works. It's the solution. You'll control your money, kill UBIT, and pay way less taxes. To learn more about this strategy and free up your retirement money, get the newest EQRP special report. Text GRE to 307-213-3475. That's text GRE to 307-213-3475.
This is the EQRP Company's Damian Lupo. The scarcity mentality is abundant, and the abundance mentality is scarce. Listen to Get Rich Education with Keith Weinhold.
Hey, well, I'd like to welcome back in Aundrea. She's my right-hand person here. She is the operations lead at GRE. Aundrea, welcome back.
Thank you, Keith. Always love to come on and to get to chat with you a bit.
As real estate investors that cultivate a lot of information-rich material, oftentimes we're looking at other sources of data. What's interesting, Aundrea, with real estate investing, it's not like there is this one central site or this one omniscient source of information that points us to the top 3 markets to invest in this year, because real estate is so granular. It's parsed by neighborhood type and property type and demographics and so many other things. I know you're not evaluating multiple markets across the United States. You're not evaluating too many of them at one time. And really no one investor can do that when there are about 400 MSAs, 400 metropolitan statistical areas in the United States. I mean, one real estate investor, they can't even evaluate 1/4 of those in any depth. So why don't we talk about what you're evaluating and what's occurring in some of the local markets that you invest in?
To your point, first of all, I don't invest in a ton of different markets. I'm not dispersed geographically across tons of markets in the US or internationally. I focus on usually a couple at a time. I don't want to just focus on a couple at a time, Keith. So one of the things I'm working on right now is diversifying where I am a little bit, just from a risk perspective. But I don't look at 5, 6, 7, 8 and dump all the data and spend, a year analyzing things before I make a decision. It's just not me personally how I invest. So right now I am focused, as I mentioned, on looking at some different markets. I'm predominantly in Georgia right now, and in Southeast Georgia, I'm in hurricane area. And so I want to get out of there. I love having my properties there. I'm keeping them, but I need to invest in some areas where if we get hit by a hurricane, I'm not going to get wiped out. We're looking at a couple of different Midwest geographies right now for different reasons. And for me personally, I do like to go out and look at some of the data. If I'm going into a market I'm not familiar with at all, I will go out to city data. I will look at US Census Bureau data and try to kind of get a feel of the market. But one of the things I really like to do is actually make connections with local people in that market and be able to, connect with investor-friendly real estate agents, real estate investors, property managers, people that are actually seeing what's going on from day to day and aren't necessarily just analyzing all the data, but that have a feel of the market and what's happening.
Yeah, now you're looking to branch out and get into different national markets. I've just simply been investing in real estate longer. So I kind of went through this process myself just about exactly 10 years ago when I began investing beyond my local market and into multiple markets in the United States, Midwest and South, pulling back, looking big picture and evaluating what market I want to get into next. Nationally, some of these big websites, they sort of give me these larger picture indications. CNBC has a pretty robust real estate page. Sometimes they talk about local markets. Housingwire.com is another source. The FRED data, which oftentimes you see me put in newsletters with those interactive charts. FRED stands for Federal Reserve Economic Data. A lot of people don't know this, but oftentimes they will give you charts on local areas and what's happening with their housing prices and what's happening with their vacancy rates and so on. Of course, there's our own website, gremarketplace.com, where we only put investor advantage markets on there. And the advantage with gremarketplace.com is you can actually find investor advantage properties there as well. But to your point, Aundrea, once I get beyond some of those bigger picture national websites, there really isn't any one go-to source. And it's kind of funny. Sometimes you just hear something from a friend and you already know that that happens to be in an investor advantage market. You just get used to investing in the Midwest Midwest and South, where you typically have a high ratio of rent income to purchase price. And then you also have those laws that tend to favor us as investors and as landlords more so than as residents and tenants. But like you were saying, talking to a property manager often makes sense. And like for me, because I'm already in so many markets, if I have a property manager that's doing an acceptable job, oftentimes I'll talk to them and ask them, hey, I'm thinking about putting more property in my portfolio. Oftentimes it's easy to talk to one of my existing property managers because I will have no additional manager to manage if with that existing manager, I already add more property to my portfolio. Talk to us some more about what you look for when you look to get into an additional market. Is you personally, as an investor, look to expand your geographic footprint, Aundrea?
Number one, I want to make sure, and to me, this is almost of the utmost importance. Number one on my list, is it a landlord-friendly state?
Yeah.
I know there are some states out there like Illinois, for example, where Cook County and Chicago is not going to be landlord friendly, but you go out to the suburbs and it may be. So it could be municipality or town specific as well. So that's number one. I look for that. Number two, I look, is this market growing or is it contracting? There are certain markets that are still contracting. Detroit is a great example. And as you know, I live in the suburbs of Detroit part of the year. There are certain areas in Detroit I would never invest in because it is contracting. It is not growing at all. That's number two. Number three is, you mentioned this just now, if I know people on the ground there that can help me kind of build my team. So it's great if you can find a really good property manager in the area, but if you can't find a great property manager and you're out of state, what are you going to do then? If it's a great market and you can't find a team to help you manage those rentals and to build your portfolio, none of the rest of it matters. Number four is understanding what strategy you want to use as you go into these markets. And what I mean by that is, do I want to go for a long-term buy and hold rental? That is mostly what I personally do and I prefer. Do I want to do a short-term rental? Am I looking to do a fix and flip or a BRRRR where I'm buying rehab and repeating? I'm refinancing it and pulling that money out and buying another one. So that's kind of the fourth thing that I look for personally.
Yeah, we can talk more about the long-term rental versus short-term rental markets in a moment. I know you like to look at some MLS data, some multiple listing service data, because you are a licensed agent, among other things. So talk to us about what you get from the MLS data. First of all, how you go about accessing that, and then what you get from it.
The geographies that I serve, where I'm a realtor and a member of that local real estate association, I have access to their MLS. What that can provide me is not just access to see the properties and all the information that I need. It also allows me to pull reports and see what's happening in that local market. And so a couple of the key performance indicators that I personally look at to see what's going on is, how many days on market do we have? Are we seeing the days on market go up, go down, stay the same? That lets me know kind of how hot that market is. The other thing that I look at is, what did the house list for and what did it actually sell for? Right now, in a lot of markets, we're seeing the days on markets get higher. We're also seeing that list price to sales price change. So we're seeing homes are selling for less than what they're listing for. That's a good indicator that the market's changing a little bit.
Yeah, that's right. Before we talk about some more of those metrics, what about an investor that wants to get access to the MLS or MLS type data? Is there a good way for them to do that and get their hands on it right away without having to go through a licensee or an agent?
You can. So there are some sites out there that will provide you some data around it. The MLS reports, from my experience, that come directly out of there are going to be the best, most up-to-date, accurate data. So it's a little bit harder if you're not a licensee. You can go out to these sites like Zillow and Realtor.com, and you can look for a geographical area and see what homes are listed for and what they're selling for. That data is out there. It's just getting a consolidated report just a little bit harder to get your hands on.
Now, you mentioned the days on market. Oftentimes when one is in the MLS, they'll see that abbreviated as DOM. And that's often cited as a very good supply demand indicator, that days on market, the days that a property is on the market before it is snapped up, because that supply demand indicator, that helps be indicative of prices and interest rates and the affordability of a property. So talk to us about what you're seeing with the days on market.
In many markets, and I want to speak specifically to the ones that I'm a realtor in and actually evaluate, I am starting to see those days in market are going up over the past 2 to 3 months. There's so many reasons for that, but it's happening. I network and talk to realtors and investors in other geographic areas as well. And in many of those, we're seeing that happen kind of across the board right now.
We are seeing the days on market increase in a number of markets, meaning that the demand is waning somewhat. It still seems to me to be quite strong in most of the markets that I look at. So in order to apply a number to that, we look at days on market. We typically see 30 to 45 days is what's considered a balanced market. So for properties on the market, therefore, more than 45 days, well, properties are languishing and demand is low. But yet if days on market are under 30 days, that would be deemed as a seller's market where properties are getting snapped up fast. So what sort of days on market are you seeing, Aundrea?
Yeah, we're seeing on average between like 35 and 45 in the markets that I'm in.
Oh, that many.
We are. One thing I think is important to mention, though, is that data changes drastically based on the purchase price. So homes in our market in Georgia, homes that are under 250,000, you're not going over 30 days on market on average. When you start going over that 250,000 range, that's when you're seeing the days on market increase.
That's a great example of how real estate investing is so nuanced and it can be parsed so many different ways. We talk about the sale to list price ratio as another indicator of supply and demand in a market. And we're talking there about what the buyer pays for the home divided by the last list price. Really, that's what the sale to list price ratio is. That number expresses a percentage. So typically when we see a sale to list price ratio of somewhere between 95 and 99%. Now that's what's deemed as a balanced market. So to give an example here, say that a buyer bought a property for $490K. So that was the sale price and the last list price was $500K. So therefore, that would be a 98% sale to list price ratio. And hey, really simple math here. Real estate is all simple math. It's just addition, subtraction, multiplication, and division. I've never used calculus or exponents in real estate. That's simple math, the sale to list price ratio. So is there anything specific with that you're seeing, Aundrea?
First and foremost, that if it required calculus, I would not be a real estate investor. So
yeah, that doesn't work well in an audio format either. So it's a good thing we didn't have to go there.
That's a great point. We are starting to see that ratio change a bit, right? So we were seeing oftentimes in the Georgia markets that I'm in that the sales price would actually be higher than the list price. That is not happening as much anymore. It does occasionally. It doesn't more often than it did. So what we're seeing now is you'll usually see like a 90 to 95%.
So in the markets that you deal in, are you seeing more of a balanced market overall with these measures than you are a seller's market?
It depends again on kind of the sales price. It's really hard to say, yes, we are, no, we're not. If you're seeing under that 250,000, it's still a seller's market. If you're going over that, it's starting to get pretty balanced now.
So you had mentioned short-term rentals before. Talk to us about what you're seeing in the short-term rental market, Aundrea. We talk a lot about long-term rentals here. Tell us about STRs.
So I personally have a few short-term rentals myself. They are all in the coast of Georgia in the Golden Isles. They're still staying booked. I'm not having any issues as of right now. But what I can tell you when I look at the analytics and a site that I personally like to go to kind of get short-term rental analytics is AirDNA. There's several of them out there. That's one I like personally. AirDNA shows you actually how many rentals are in your particular market. It also shows you what the grade of the market is. Do they consider it an A, a B, a C market for short-term rentals? It shows you even how many 2 bedrooms versus 3 bedrooms there are and what their occupancy rates are and what their average nightly rental is. So there's all kind of data out there that you can mine for this. We're seeing in our market right now, we're still an A market. We still have high occupancy rates. We still have high average nightly rates. What we are seeing, though, that's concerning me just a little bit is that we're starting to get more rentals on the market. I feel like there's a little bit of a lag right now in what we're seeing with the data compared to what's going to happen in a few months or even next high season. We've got so many coming on the market right now. At some point, there's going to be some type of shift to where there's so many rentals that the prices are going down and the occupancy is going down.
And you're talking specifically about short-term rentals now with this potential future saturation?
That is correct. Not long-term at all. There's still such a need for long-term in the markets that I'm in.
Interesting. The 2 markets that you predominantly work in, they're really a pretty good sample size. One is in the south, One is in the north. We're talking about coastal Georgia versus metro Detroit.
Mm-hmm.
One caters to vacationers more there in South Georgia, and one to more of an urban clientele there in metro Detroit. And we talk about short-term rentals. Tell us from your view about some of the differences between short-term and long-term rentals. I talked about this a few weeks ago. You own both types. Tell us about that.
I will, scream to high heavens. I much prefer long-term rentals to short any day of the week. There's a bigger demand for them. They're easier to deal with. Your returns are a little bit more stable and less cyclical. And your vacancy rates are just so low, especially the last few years. Short-term rentals, you can make more money. So you can make a lot more capital in a shorter amount of time, but your cash on cash returns lower your first year or two with short-term rentals. You purchase a short-term rental, you're typically putting the same type of down payment to get those. What you have with short-term that you don't with long-term is that upfront furnishing cost. And that can be pretty expensive. You can have a small 2-bedroom or 3-bedroom home, say 1,200 square feet, and you're still looking at about $15,000 on average, depending on your market, to furnish that. So that's a lot of upfront capital. It also requires a lot more management than long terms. I can farm out my long term to a property manager. I can manage them myself, and it is such a small time commitment to do. Short terms, you have to find a really good property manager to manage it. There's not a lot of them out there in certain markets. They have to be on top of things. They have to make sure that they're coordinating cleaning schedules and they're coordinating guest check-ins, checkouts, that they're automating things. And I think there's still a little bit of a curve for that right now. And a lot of companies are not doing that the way that they should. You also have to make sure that you're managing guest expectations, that you're staying on top of local regulations. There's a lot of short-term rental regulations in comparison to long-term. And so there's just a lot more kind of effort and things to think about with the short terms and long term.
Short-term rentals, once you get it all dialed in, it can produce a better income than long-term rentals. There is a lot more to maintain. I seem to run into a lot of people that like to talk about how much income their short-term rental generates, and it is definitely something worth hearing about, but I just don't know how much they're really valuing their time when they're getting into the maintenance and managing the listings all by themselves. And then, of course, you do have some of those upfront costs, like you mentioned as well, maybe $15,000 to furnish it, and then long-term rentals, of course, have that better recession resistance over time. You talk about the 20% down payment that oftentimes one puts on a long-term rental in the 1 to 4 unit space or in short-term rentals. Talk to us some more about the availability of short-term rental loans versus long-term rental loan availability.
So for me personally, and I'm just going to speak from my experience because there's tons of loan programs out there that people can utilize. I do your typical Fannie Freddie 20% down loan. So I don't do portfolio loans. I haven't personally done a DSCR loan, which is a debt service coverage ratio, but there are plenty of lenders out there that will underwrite that. What I mean by that is I do your typical, they look at my income, my debt to income ratio, my credit. They look at the performance of my other properties if they're on my Schedule E, and they determine if I can qualify for that loan. With debt service coverage ratio loans, those are a little bit different because they're actually looking at performance of the property as opposed to your personal kind of credit and debt to income ratio. So those are really good options that people can use for short-term rentals if you don't want them kind of diving into your credit, looking at some of those personal things. You're wanting them just to evaluate the performance of the property.
Well, here we are around mid-year. From the investor perspective, is there any last thing that an investor should know, whether that's an underappreciated resource or maybe a niche that's not being explored as much as it should be, or just anything an investor should know today?
I'll just harp once again on the networking. And if you're interested in a local market, get involved with people in that local market because sometimes the data lags a little bit behind the local boots on the ground knowledge. So that's what I would recommend to people outside of the data.
Yeah, it's really granular. And again, there isn't just that one go-to place, one app or one click, and there you go with the answer on where you should invest or what you should invest in next. Aundrea and I have compiled and cultivated a resource that winnows down some of the best United States markets and the actual properties for sale to find in those markets. Tell us some more about that.
So if you go to gremarketplace.com, we have an entire resource there for you to find different markets. You can find out market statistics, what's happened there over the past couple of years, what types of properties are available, what the property management teams look like, feel like, sound like. You can actually meet them via video. So that's a really good place for you to go out there and analyze and try to help kind of nail down which market may interest you. So if you're interested in that, go for it. We also have an investment coach here at GRE that has sometimes access to off-market properties in addition to being able to pair you with those different geographies. So if you're interested in that, you can also find him out there on the GRE marketplace.
Yes, there is our investment coach, Naresh, which you have met here through the show. Aundrea has interviewed most of the property managers in these markets that we've carefully hand-selected and put on GRE Marketplace. You can see Aundrea with the property manager there. And again, there is no one-stop shop. No one site, no answer in red letters up in the sky that says it's in this market on this day and it's this particular property at 321 Mulberry Lane. But maybe you can narrow it down to, say, 3 markets at gremarketplace.com and see what fits your investor personality the most, whether that's a high appreciation market or a high cash flow market or whatever it is. You can get started with that again at gremarketplace.com.
Thank you so much for having me on, Keith. I appreciate it.
Yeah, great stuff from Aundrea as always. We discussed markets, and of course, it's about the sub-market too. As an example, maybe you don't feel like a place like Erie, Pennsylvania, or Toledo, Ohio, or Grand Rapids, Michigan are fast-growing markets. Actually, I think Grand Rapids, for one, is growing. But the point is that even if a metro just merely has a stable population, but say its medical district is booming, like a lot of cities' medical districts are, you may very well be better off in an okay metro with a booming medical submarket than you are elsewhere if you own a rental property in that medical submarket. So it's often about that submarket within a metro that really matters to you. There just aren't too many places that you can invest and get a good yield today, but high inflation is one motivator to do so. So create one login, one time, it's free, and get access to all of our providers at gremarketplace.com. For everyone here, COO Aundrea Newbern, MBA, content manager Matthew Blunt, producer me and Bidron Jampo, sound engineer Bidron Jampo, investment coach Naresh Vissa, website Marvin Diaz Jr., advertising Jake Madoff. I'm your host Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.